So yes, hello and welcome back to a BG Dollars video. Now today we're discussing stagflation. What is stagflation? How is it going to affect you guys at home? Especially if we are investors, how is it going to affect the markets as well? And what can we do about it? Let's get into it. But first of all, I want to just go through the markets and how they performed this week. Look, the S&P was down 4.58% from Monday to Friday. The Nasdaq was down 5.7%. Apple down 5.66%. So terrible week in the markets just across the board. I mean, DocuSign has a look at that, down 21.29%. It really was a very shit week. Again, Google down 2.95%. All your big names were down. Microsoft down 6.3%. You had PayPal down 8%. Nvidia was down 9.34%. All your big names were down. Amazon down 10.29%. Amazon was down over 10% in 1 week. Let's over to the risky whiskey watch list. Now, this is all my risk plays, risk stocks. You're talking small caps, talking meme stocks. Look, GameStop down 2.95%. Not a too bad week for GameStop there, actually. And AMC only basically flat, basically traded flat. Roku down 5.21%. TDoc down 8%. ARK must have had a poor week there then. Let's see. Shopify down 1.53%. So not too bad of a week for Shopify there. ARK down 4.84%. Dreadful week there. What about the Hood? Oh, the Hood's gone now. Affirm only 18.7% down for Affirm. Again, Marathon Digital 14% down. Tilray 18. I mean, any of the cannabis plays would have just got wrecked in that last week. So yeah, bottom line was awful week for stocks. Awful week across the board. Across the board. Of course, that inflation report came out and everything just tanked from there. It was not looking good, which is why I've brought this video out on stagflation today. BG Dollars, please do follow me on Twitter. I am putting up, look, you've got there, look, CPI report. So you can see when I'm releasing my videos, you can see what videos I'm bringing out. Look, you've got some charts there, some interesting information. You know, Tesla doubled the number of employees in just 2 years. From 2019 to 2021. So yeah, I'll just bring out stuff like that, information. And you can obviously get early releases from my videos. So you can see what videos are coming up. But what is stagflation and should we be worrying about it? The steepest inflation in 4 decades and severe product shortages have evoked comparisons to economic doldrums faced by the US in the 1970s. Now, actually, I just want to pull up a chart about the 1970s because this was the last time we faced stagflation. And look what happened to the market. Boom, 1973, early 1973, we hit the peak. Similar to 2022, if we think about it. I mean, we started the year off like this, and look, 2022 has started similar to this year, to 1973. But anyway, look what happened. Boom. Down, 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 down. Sideways, sideways. Didn't return back to all-time highs. Still haven't returned back. Boom, here. 1980. So 7 years where we couldn't get past all-time highs. So 7 years the market done nothing, absolutely went nowhere. So if you'd invested right here, you'd have been smashed out the park for 7 years. And that is when stagflation's happening. So stagflation is awful for the markets. Let's just get that straight. And the last time it happened was 1970s. I think that was the only time it may have happened, stagflation. So yeah, this danger of stagflation is considerable today, the World Bank warned this week. Several years of above inflation and below average growth are now likely. So that is not what you want to hear from the World Bank. But I mean, the World Bank don't really do much. I think they just overlook sort of things here and there. Latest US government shows the consumer price in May, as we all know, climbed 8.6%. If you haven't watched my inflation report, please do watch that one. Because I was just going mental at the report, to be honest with you, because it was very, very bad, very bad. And we're looking at the markets, they were just dropping. And didn't really quite know what to do with myself at that stage. But anyway, what is stagflation? In its strictest sense, stagflation refers to a stretch of rising unemployment coupled with sharply increasing prices. So obviously we can actually tell the jobs data is still looking quite strong as of right now. Unemployment is still very, very low. So we can't say that stagflation has arrived just yet. We do need an economic downturn before we can say, oh, this is stagflation. And we also need inflation to plateau at these 8% levels. But of course, the worry thing is that I did mention in my inflation report is that we have started raising interest rates. So inflation technically should be really sort of peaking. And yet again, the May report was highest in 41 years. So that's warning signs there. When we start tightening more and more and raising interest rates more and more, if inflation doesn't start to come down, then we are faced with stagflation and unemployment rates will rise. High prices squeeze household budgets and reduce consumer spending, while weak economic activity means businesses grow slowly, if at all, and corporate profits slump. So I mean, stagflation is really bad for any sort of stock, any sort of market. Look, toxic stew of high unemployment and high inflation persisted for over a decade as the US, UK, and parts of Europe. So over a decade of stagflation, that's what I mean. It doesn't just come around here and there. It's here to stay. The OPEC oil embargo in 1973 and a drop in oil production after the 1979 Iranian Revolution. This is all just sort of talking about the 70s. Are the 1970s about to repeat themselves? You know, has the S&P 500 peaked in 2022? And we ain't going to see that until 2030. Who knows, the S&P 500 might not return to the peak that we saw in early January till 2030. Who knows? If you bought then, you're done for the next 8 years. That could very well happen. Russian invasion of Ukraine in February, coming after a year of global growth, caused a spike. We all know about the spike in energy prices. I mean, energy has just been soaring, hasn't it? Of course, prices at the pumps, bills, gas, like it's all just been inflationary pressure, and it's just been immense, to be honest with you. US economy has evolved in important ways. Yeah, that's something that we can take note. In the 70s, the Fed had a lot less options that they could sort of choose to deal with stagflation. You know, there wasn't actually quantitative easing, there wasn't tapering, there wasn't sort of bond buying, there wasn't really any of this back in the 70s. It was sort of just interest rates up, interest rates down, and that was sort of all the Fed could do. It was a lot harder for the Fed to deal with stagflation in the 70s than what it would be now. So I don't see it just being as drastic. I don't see like sort of 10 years of where we're just stagnant and inflation is consistently high, because the Fed's got a lot more things up their sleeves that they can pull out and think, you know what, we're going to do this, we're going to do that, we're going to bring this in, we're going to bring that in, that they could have done in the 70s. So that's my viewpoint on it. And that's what they're saying here. Look, modern economies are now much more efficient in their use of oil than they were in the 70s. A much larger share of GDP is composed of production services. I'm saying we've just evolved in all terms of finance and economies and economics and that, and policies and all this. We've just evolved into a much better sort of society that can deal with these sorts of situations much better. Consumers continue to spend at a healthy clip despite high prices. Businesses continue to hire. See, that's good. We're not going to enter a stagflationary period unless businesses stop hiring. We see unemployment rates start to rise. We see inflation still at those levels when these things are happening. See, the whole idea would be is that if unemployment starts to rise and businesses stop employing, then you see inflation starts to come down as less people have less money because not many people are working. That would be the whole sort of thing. But if inflation stayed high when that was happening, that's when I could officially say, right, we're in stagflation. So how likely is stagflation to happen again? Here we are. Economic data show that inflation may have peaked while consumer spending remains strong. Online prices fell in May for the second month, and wage increases, one factor behind rising prices, are also slowing. So that's good signs. That's very good signs. War in Ukraine and the global food crunch create conditions that lead to an acceleration in prices. Of course, that's the thing. Some of the factors are just out of the Fed's hands. They can't do anything to do with the war, can they? They have no power over that. So sometimes, of course, oil, prices of that is going to be impacted upon what's going on in the war, which the Fed has no control over. So that could be a factor into whether stagflation does come about or not. There are two major ways that inflation pressures ease. I'm going to say supply chain snags were to ease, making cars, electronics, food, and more plentiful. Prices would fall quickly. Of course, this is only this guy's opinion. That's what I'm saying. People believe that, oh, he's big economist, you know, he's got a degree, he goes to Mellon University's Tepper School of Business, he must be right, and just presume that this is right. It's not necessarily. But of course, I would agree, if supply chain issues do go away, then that would definitely help inflation, and it would help bring down inflation as well. As far as the Federal Reserve is concerned, the best way to head off stagflation is to raise interest rates high enough to dampen consumer demand. That's what the Fed did in the 1980s under Volcker. That was the Paul Volcker period, wasn't it? He just kept raising rates. Yeah, he just conquered inflation over job growth. He didn't care about the economy, he didn't care about business growth, he didn't care about unemployment. He was like, I'm getting inflation under control, and that was it. All he'd done was rise interest rates after interest rate, month after month after month. And yeah, of course it was a painful period for most Americans. That would have been very harsh indeed. Because as I said, he didn't care about whether people had jobs or anything. He didn't really care about the people. He just wanted inflation down. But that's what I'm saying. For the goodness of society in general, as a whole, for the future of the nation, that was probably the right thing to do. But at the time, at the moment, of course, it was going to be hard for Americans. They don't have many tools to fix the supply chain problems, but that means the demand adjustments needs to be even harder, Spat said. I think we're going to see higher interest rates to reduce demand by companies, reduce demand. Of course we're going to see higher interest rates. This guy is just stating the obvious here. I think everyone knows we're going to see higher interest rates. Fed's increased its target. Well, we know this, don't we? Higher borrowing costs have already had an effect on the housing market. Yeah, mortgage rates are already rising. So, and also, don't forget about the the inventory issues that I brought up. There was a video on that. Probably put a little link in there as well, up in the info section. But yeah, there was a video on the inventory issues that I made, because of course companies are saying they've got massive inventories and they're gonna have to reduce prices to get rid of the items. They've got no room in their storage units or anything like that to bring in items for seasonal differences. Like, they don't want to be stuck with a load of summer stuff, summer clothing, say, when it comes into winter. They're going to want to get rid of that. They're going to want to sell it. And they said they're going to have to start reducing prices. That was your Walmarts, your Targets, all this, that were coming out and saying that, weren't they, about their inventory difficulties. So yeah, I think bottom line is, we don't want stagflation. What's going to have to happen for me to say, right, we're in a stagflationary period, is that unemployment and job data, unemployment needs to rise, shaky job data numbers. We need businesses to stop hiring. We would also need inflation to stay at this 8% whilst all that is happening. That's when we're in a stagflationary period. And that is when it's very, very shaky for a market, such as like the S&P, such as stocks, anything. It's very shaky to just own assets at that stage. It would be a very hard time. So yeah, we really don't want stagflation. It would be the last thing we wanted. We want inflation to start coming down. We want the Fed to raise interest rates. That's what we need. On that note, please do subscribe to BG Dollars. As I said, follow the Twitter, BG Dollars. I put up information there, what new videos I'm bringing out. And yeah, leave a like. I'll see you in the next one.